Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And once again, it's my pleasure to welcome you to another Subscriber Request Tuesday, where every Tuesday I cover either stocks or industries or sectors that subscribers have requested. And, you know, this is you asked, and my job here is to give it to you. Now, one of the interesting sectors that we've been dealing with here in this crazy market environment we've been in is, of course, the home building sector. Housing is hot. I don't know, how it is in the rest of the country, but here in Florida, you can bid more than the people are asking and still lose the sale of the house. Houses are actually still in short supply. So the sector is hot, and the stocks have done really quite well in this market. Now, what I want to do with this video is I want to show you what they historically look like, how they've been performing in recent years, what we might expect for the future, and then cover some of the risks that you might face investing in this sector. The sector is extremely hot right now. The question is, can it stay that way, and will it stay that way, and can you invest in these companies today at rational valuations? So let's go ahead and get into the companies here. Now, the Wall Street Journal produced an article back in March of this year, and it was titled, "The Pandemic Ignited a Housing Boom." But it's different from the last one. Now, this is important. I wanted to start out with this because, as we know, the Great Recession of 08 and 09 was caused by the loose lending practices where money was almost, given to people who couldn't pay it back. And, of course, it ended up being a house of cards and collapsed the whole industry. And I'm going to show you what that did to these guys. But they're saying it's different this time. This time, mortgages are stricter, down payments are higher, and tight supply is supporting prices. And it's an interesting article. And they go on to talk about, this is the biggest real estate market since 2006, just before the housing bubble burst and set off a global recession, as I pointed out. Then a little bit more recently, we had Barron's magazine on June 28th of 2021 come out with an article saying the housing market is still hot. That's good news for these three mortgage insurers. And it was primarily talking about the mortgage insurers, but the key here is that the housing market is still hot, even though mortgage rates look like, interest rates might be rising. That's a risk that you're facing. And some of the mortgage applications have dropped a little bit. But the point is, the market is not cold by any stretch of imagination, even if it's cooled off a little. And then, last but not least, on June 28th of this year, National Mortgage News had an article that I found interesting, and it said, "What housing bubble? Price growth driven by fundamentals," analysts say. And what they're saying here is that, the bottom line is that the increasing value of homes is really driven by the fundamentals and by the supply situation. So the point is the industry is far from being, quote unquote dead. Now, there are a lot of home builders in this country. In fact, all over the world. I screened for home builders. I came up with, I believe it was 55 names. Then I kind of further cut that screen down to home builders just domiciled here in the USA. And I came up with 9 companies that were slightly below investment grade. And some of these are reasonably popular names like Beazer Homes and KB Home and Meritage Homes Corp, Toll Brothers. These are all pretty well-known names in the industry, but I want you to notice none of them carry investment-grade credit ratings. And there's actually a lot of leverage in this particular subset of home builders. So I'm not going to cover these individually, but I do want to show you a couple of them. I'm not going to go through all of them. I'm going to go only through a couple. Let's start with Beazer, because I want you to see the nature of the beast here. One of the reasons I always look at these historical graphs is because they tell me a lot about the business. I always like to remind the viewer that I don't invest in the past. I invest in the future strictly. But I can learn a great deal from the past. And Beazer, prior to coming into the housing bubble, which is the Great Recession that we see here, it was just rocking on all cylinders. Earnings growth was extraordinary. The company's stock price was rising dramatically. Then the housing bubble hit, and the company's earnings collapsed, and they, literally were close to going into bankruptcy. And then even several years coming out of the Great Recession, their business really did not perform well. Now, since coming out of the recession, starting in about 2014, they started to make some money again, and the business has been growing, but the valuation was so bad because of the negative earnings growth that there was really no traction in the stock price. In other words, from that peak to the last closing price, it actually generated a negative rate of return. Now, if you'd have bought it in the throes of the Great Recession at the very worst, it would have generated about an 18.5% rate of return. But you can see a lot of volatility and not very much going on. And then the company started making money again. All right, now, even since it still started making money, I do want you to notice because of the high valuation, there wasn't really any really good performance. The company became reasonably valued, which is always a critical point that I try to cover in these videos. And then if you'd have bought it, at a PE of 9 in February of 2016, even though it remains undervalued today, your blended PE today is only 7, you'd have still done okay, making about 20% a year, because that's how fast, you can see the growth rates here have been extraordinary. And I'm going to shave some more years off here so I can get a growth rate. And you can see that the company was growing earnings during this time at about 31% a year. But now, even with that spectacular growth, I want you to note that the market has really given kind of a jaundiced eye on this stock. The PE ratio, the normal valuation the market has applied, calculates out at 13.39, but note that the stock multiples have been significantly lower than that. That's something I want you to take into consideration when you're looking at these companies. Another one I'd like to go ahead and look at would be Toll Brothers, which is another relatively famous one. Again, I'm not going to spend a lot of time on these particular companies, but you see a little better record here. Same story. They were doing really well. The recession hit. They did very poorly, and then they started making money again, but they've been very erratic. Company's only BB+ rated, does pay a little dividend. They started paying a dividend really in 2017. They were hit by COVID pretty hard as a home builder, but nonetheless, it's been performing as a business reasonably well and is considered to perform going forward. But I do want you to notice, once again, we see relatively low multiples. But I'm not saying these stocks aren't good investments. They actually could be. I just think these are a little riskier than the ones I really want to focus on in this video. So what I want to do is move to the home builders investment grade that I discovered. These are all companies that have investment grade credit ratings, BBB- or higher. And they're some of the biggest names and also some of the biggest in terms of market cap, although MDC Holdings only has a $3.5 billion market cap, but Lennar has a $30 billion. DR Horton has $32 billion, and then, of course, NVR at $17 billion and Pulte at $14 billion. So these are the biggest, but they have very good balance sheets, which I think partially explains their credit ratings. So let's look at how these companies fared going through the housing bubble. Once again, we see this very similar, what I'll call picture. They were doing extremely well coming out of the 2001 recession. Then the Great Recession hit. Earnings collapsed. They had negative earnings growth for several years. And they had a huge 2012 where the market kind of heated up. Earnings, fell after that. But since that time frame, you can see earnings growth has been very good. The company did eliminate their dividend, but they restarted paying it again in 2014. Their dividend record has been, I would say, decent. I've got no forecast for the dividend currently, but that's all that means. It means there's no forecast. Doesn't mean that they're not going to pay a dividend, because you're buying the stock at about a 3% yield. The normal multiple on this stock, though, has only been about 9.5 times earnings. Now, it depends on what the time frame you're drawing. I want to make that clear. Okay, this is a very dynamic tool, fast graphs, and when you change time frames, you get different numbers. It's an analytical tool. I want to remind you, those of you who are subscribers, to make sure you run these different time frames and analyze it, learn from the past, but then always focus on the future, because the future is what you're going to invest in and where you're going to make money. Now, the normal multiple for the last 5 years on MDC Holdings has been 11 times earnings. I'm only getting a forecast going out, and I have very few analysts following this particular, even though it's investment grade, it's not being widely followed, but I would have a very powerful annualized rate of return out to the next year if this company were to go from its 7.6 blended current PE ratio, but it does offer a very, very strong 13% earnings yield. If it reverted back up into that, 11 PE, you would have a tremendous rate of return potential. If it only traded at that 9-ish PE, you would still have a very strong rate of return potential over the short run. The point is, the stock is very undervalued and it's growing quite nicely, expected to grow quite nicely. And let's check, long-term growth is also expected to be over 30%. But keep in mind, we're looking at 8 or 9 times earnings here. So if I'm looking at this stock from a standpoint of, what the future might look. I don't, even though the growth rate is expected to be very strong, I would be valuing it at a lower PE here, just simply because the market clearly has a penchant for doing that. And again, what I'm trying to do here is give you guys some insights into how to use this tool. The blue line, shows that the market has, undervalued this stock or valued it at a low multiple, 9, 10, 11 times earnings quite consistently. And keep also in mind, this is a reference line. Okay, so right now I've got, on the time frame I've got here, I'm going to take another year off of that. I've got a normal PE of 12.74. But there are times when it's higher than that, if I run my mouse along the black price line here. And then there are times when the PE is lower than that. Use this as a valuation reference is the point I'm trying to get across. Moving on here now, we're going to go to Pulte Homes, one of the better known home builders out there, at least in our market here in Florida. Triple B minus rated, only has 23% long-term debt. Once again, we see this, same picture. They were doing extremely well when the, loose money was running rampant. The money dried up. They all collapsed. Their earnings collapsed. They came into 2012. They all had a big surge. The stock price kind of react. But then following, 2012, going into 2015 forward, we've had, very nice earnings growth here. So if I look at Pulte, you can see they've grown earnings at over 28%. But once again, the market puts a very low multiple. These stocks tend to trade at about a 10 multiple, 10 to 12 multiple historically. So when I look at forecasting, we're expected just under 20% growth. But again, if I apply the normal multiple of 10-ish, 10.6 is what the blue line is being drawn at right here, you still have tremendous rates of return if the stock just trades back to that normal multiple. And then the long-term growth rate is expected to be 30%. So analysts are still very sanguine about these companies. They still expect a lot of greatness from them. The companies have good, strong balance sheets, which I'll get into when I cover the last one I'm going to cover here. But the point is, you're buying them at very low multiples with very high earnings yields. But note that normally a stock growing this fast would trade at a PE ratio equal to that growth rate. These companies are heavily discounted, which tells me the market still doesn't totally, I'm going to use the word trust, that these companies are going to be able to continue to generate the results they've been generating. Lennar is another very popular one, $30 billion market cap, one of the biggest, 23% debt. It's triple B minus rated, which is, again, investment grade. We see that same story, and I keep focusing you on this because I want you to realize that these guys were doing really well for years, and then, when the housing bubble collapsed back in the 2008 and 9 recession, these stocks got hit hard and they got hit early. I also want to make that point. But now, since coming out of the Great Recession, these companies have fared very well. They've grown their businesses very well, and their prices have followed. But here we're using a 13 PE ratio with the blue line, and notice for the last 2.5, 3 years, it's traded below that. If I go to the forecasting graph here, earnings are expected to grow for the next couple of years at about 11%, but that's 70% this year, and then slowing down to only 3 and 2%. That's something also to be concerned about. The normal multiple here on Lennar, again, is for the past 5 years has been 11. As you can see, in recent years, the PEs of these stocks have fallen dramatically. Even at their best day, they were only trading at 15 multiples. But, now we're looking at an 11 multiple over the last 5 years, which is what this is drawn with. This would give you tremendous rate of return with a 1% dividend yield and, decent histories here. This stock is actually one of the better ones in the group. Next one I want to show is DR Horton, another, I think, one of the better names in the industry, has a very strong balance sheet, only 18% debt, triple B rated credit rating. But again, even these best-of-class names suffered during the housing bubble. And then it wasn't until after the housing bubble that they began growing their businesses again. But once again, we see this 10 multiple. I really want you to focus on that. These stocks are not giving multiples that are anywhere near close to their growth rates. We're expecting 18% growth, very strong growth in 22 and 23 as well as this year, in contrast to what we just looked at. But nevertheless, the market's been applying around a 12 or 13 multiple over the last 5 years. If I look at it, it's been 11 or 12 times earnings significantly for several years, almost the entire history here. So you don't value these based on their growth rate. You value them on this lower multiple, but even then you've got significant rates of return here. These are, growth stories with moderate amounts of risk because, as I'm going to get into, the financial statements actually look pretty good. The last company I'm going to cover is NVR. Doesn't pay a dividend. It's a $17 billion company. It's the highest rated with BBB plus rated of the group. Notice that this one fared best, which tells me a lot about their management as they came into the housing bubble. They definitely saw their earnings drop rather dramatically, but I do want to make the point that they stayed profitable. Okay, and then the company coming out of the Great Recession has really been able to grow their business at a very, very strong rate, as I'll illustrate here. They've grown by over 24% a year. You can see how the stock price has traded that. But I also want you to notice the real exception here, and that is a normal PE of 20 over this time frame. If I go to the forecasting graph, there are 6 analysts forecasting the company to grow at just under 22% a year, about 39% this year, 14% next year. The long-term trendline growth is expected to be about 17%, which would indicate that this stock could look a little bit overvalued. When I look at normal multiples here and I look at it historically, this company trades at 17 or 18 times earnings. So using a 17 PE here, we'd have a rate of return of about 18.69%. If I use the long-term growth rate and I went to an 18 PE, you could annualize it plus 15 or 16%. Now, as I mentioned, this particular stock has one of the best balance sheets of any of the companies that I've covered here. So let's go into fund graphs and let's look at NVR, and I want to show you a couple things that I think are very interesting. The company does not pay dividends. Okay, I'm going to show you something else here in a moment. The valuation has been higher than most of the others, but this company has more cash than they have total debt. Okay, that's a very strong, testament to the strength of their balance sheet here. So I wanted you to see that. I also want you to see something else relative to how their business has been run. If I look at common shares outstanding, this company's been buying back stock quite a bit. They've reduced their share count from 10 million shares down to 4 million shares. And when I look at that in the context of how the business has been, it's been reasonably valued relative to its growth rate that whole time. So this one is a little bit different than any of the others I showed you. It's probably be my favorite in the group, but as far as the quality of the business and the growth, but I also think it's one of the higher price. Anyway, this has been the home building industry. It's a very interesting industry, very hot. Performance has been exceptional in recent years. If I look at NVR with no dividends, you can see that it's outproduced the market rather dramatically. Over the last 14 years, it's done even better. So, bottom line is these are very interesting stocks to buy for capital appreciation and growth. You asked and I delivered. I hope you liked this video. If you did, give me a like, ring the bell, give me the thumbs up, obviously, and subscribe to the channel. The home building industry is hot right now. Most people think it's going to stay hot for a while, but I'd also caution you to be very careful. Watch interest rates, especially on the mortgage rates, and watch the demand for mortgage applications and the supply and demand of housing, because as I showed you over almost every example I showed today, the prospects of this industry can change, and it can change very, very quickly. It can go from being very profitable and growthy to very unprofitable and negative growth in just a blink of an eye. So keep that in mind when you're thinking about investing in the home builders. Thanks for watching.